This is the essence of buying low and selling high. This discussion is going to center around what will eventually lead to buying opportunities of a lifetime. And so it's very important that we discover when are the best opportunities to buy stocks. Okay, and so that's what we're going to do here. So let's get into it. I love it. Right? It's a great slide. It says, you want to really make some money? Go bottom fishing. And it's absolutely true. In just a couple of weeks' time, if you get the market bottom right, in just a couple of weeks' time, you can make more profits than you'll see the rest of the year in some cases. Okay? And so that's how important it is. And that's how profitable it can be. And so let's dive in. Bottom fishing, there's that word again. Bottom fishing is the art. It's an art form. Okay? It's something you're going to work at a little bit, but VectorVest is going to be there to guide you. And that's going to go a long way towards helping you accomplish your goal of buying beaten down stocks at market bottoms. So bottom fishing is the art of buying beaten down stocks at market bottoms. So the idea is some of the best opportunities are the stocks that have been beaten up the most in the current market correction that you've had to endure. They tend to yield the best potential when you buy them once the market has bottomed, stopped going down, and started to go back up again. And so what we need to be able to do as investors is we need to be able to recognize first and foremost when the market is likely hitting bottom, and then what you'll learn this afternoon after lunch in one of the highlights of the show, I think it'll be for you, you'll learn how awesome the power is of buying some of those stocks that have really been creamed and watch them soar. Absolutely take off like birds. It's tremendously powerful. Okay, so it sounds easy, right? It really does. Just buy beaten up stocks when the market's hitting bottom. Couldn't be any easier than that. And really, the truth is, it is that easy. But what you need is a systematic way to do it, right? And it requires a new paradigm. Who is it? Warren Buffett, right? Says, when's the best time to buy stocks? Anybody know? When nobody else wants to buy them is a good answer. The way he says it is when blood is in the streets. When blood is in the streets. When you absolutely feel like the best thing you should be doing is stuffing money in your mattress. Did anybody feel that way as we got into 2008? Anybody find yourselves calling people saying, hey man, put some money in your mattress? Right? We've gone through 2 crises here and things look about as gloomy as they can possibly be. I'm just sitting back smiling saying, there's a buying opportunity of a lifetime right around the corner. And this is when they happen. And the really cool thing is, VectorVest will show you when and how to do it. And so my job here is to lead you down that path. Jim Penna after lunch is going to complete the task. But I'm going to show you the important things to look for in identifying market bottoms with the market timing graph, primarily. So the average investor doesn't understand the beauty of a market bottom. All we feel is the pain of the market correction that we've been in. And painful they are. But the bigger they go down, the more opportunity that lies right around the corner. So I don't want you to feel pain anymore. If you follow some of the things that Jim has already alluded to in the prior discussion along with Ray, and learn how to protect profits when markets are peaking, it makes this job all that much easier because you don't experience all the pain that everybody else on Wall Street and all your neighbors and all your friends are talking about at all the social parties that you go to about the last thing you want to do is buy stocks in the stock market. You're going to say, I got a little secret, my friend, and it's called VectorVest. And it's going to tell me when I'm licking my chops. Okay? It's going to be fun. They're going to think you're a loon, by the way. Just be ready for that. All my friends thought I was loony, I'll tell you that much. Effective bottom fishing requires precise timing, absolute precision, because the vast amount of the movement occurs in just the first few days off the market bottom. As a market rallies up off a bottom, the performance of the stock market as a whole continues to weaken. Therefore, the stocks that you're purchasing, even if you're purchasing the right ones, the performance is going to weaken as you get further and further away from the absolute bottom. So it's imperative to do this and do it right and really just put a big smile on your face. You got to get precise timing, absolute precision. So let's dial in. Here's the cool thing, guys. We're going to use the same indicators that Jim educated you up on last session. And now what we're going to do is we're going to put a laser focus on identifying bottoms using the same ones. Okay? So we're still going to use the VectorVest composite. That's going to give us some very valuable information. Has anybody here ever took the time to learn candlesticks? Oh, wonderful. I got to be honest with you. That has just opened up a whole new world for me in terms of my performance, is learning candlesticks. And you're going to learn a little bit while you sit here, because I'm going to show you some cool formations. But they're very telling. They give you a lot of information about the supply and demand balance that's going on in the marketplace. And they indicate when the party is getting ready to start. And then all you got to do is be on the lookout. So we're going to show you some of those, what they call reversal patterns, as part of this, because they naturally occur at a market bottom. So we're going to be using our indicators even in conjunction with some traditional technical analysis just to kind of sweeten the pot a little bit from time to time. But the VectorVest composite is going to be what we use, right? We're also then going to use the buy to sell ratio. They say buy when blood is in the streets. Well, if there's a whole heck of a lot more sell recommendations in the database compared to buys, blood is in the streets. That means people that are holding those stocks are experiencing what kind of phenomenon? Tragedy. That's a good word. You stay right up here at the front of the show. Yeah. And so we're going to use that to help us identify when it's going to be attractive for buyers to re-enter the marketplace. Okay? Also, the market timing indicator. Now that combines the trends of the VectorVest composite price, the RT, and the BSR into one indicator. So it's got some usefulness in this as well. And the relative timing, being a technical indicator of its own right, will also yield some benefit. So I will tell you this, the buy to sell ratio is going to be your best friend in this. On the slide, that's going to be the most important one. But certainly all of these are going to be important, and we're going to cover each and every one of them, what to look for and why, and when. Okay? Let's talk about the buy to sell ratio. Great place to start. So Jim's already given you the definition. Hopefully you already understand the equation. But you're simply looking at the number of buys divided by the number of sells, right? And then if the number is above 1, you got more buys than sells and the market's healthy. If the number's below 1, you got more sells than buys and the market is not healthy. We still remember that, right? Excellent. Incidentally, when I ask a question, please respond, because I'm like the Energizer Bunny, but my batteries do run low. And every time you smile or nod or wink or something, my batteries go right back up, fully charged. All right, so when the buy to sell ratio goes below 0.2, that's the critical level. 0.2 buys to every sell. And think about that in terms of tracking 7,600 stocks in a database. You know, you're talking about the vast majority of stocks, thousands of stocks are what? Sells. And if thousands of stocks are sells, what kind of market are you dealing with? Tragedy, if you're holding them long. In order to be a sell, all those stock prices have to be doing what in price? They have to be going down. Okay? Pay special attention to divergences between the VVC and the buy to sell ratio. So let's see what this looks like. We're going to go into the platform here in just a sec, but I'll stay here on the slide, and Jim, you'll have to follow along with the mouse. But if we start at the hard left edge, that's where the market is peaking. And then, wham, the bottom drops out. Now, the market at some point will stop going down and start going up again, right? We've already covered that ground first talk of the day. And it does. It comes down, it makes an aggressive bounce to a new short-term high. Then what does she do again? She falls lower. That creates what technicians would call a lower low. And what's true about that is that the market is still overall moving downward. Now, the interesting thing that's going to occur here is while the market is making a lower low, our buy to sell ratio is not only below 2, but it's making a higher low level. And if that's true, let's think about this. I'm going to take you all the way down the rabbit hole if you're willing to go there. If the market as a whole is falling, but the recommendation profile is rising, doesn't that then mean that this last little run down has a little less weight to it? See what I mean? Fewer stocks are holding on to those sell recommendations. So what's starting to happen with the stock prices that are out there? They're starting to level, right? So this indicator is very, very smart. It can see under the waves on the surface of the ocean into the current below. Okay? And we often refer to it as the canary in the coal mine. Well, the canary was once dead and now has risen again. Been brought back to life. See what I mean? And what you want is that means that later on the canary is going to start singing again. Everybody knows that miners used to use canaries to know when they better get the heck out of the tunnels, right? Well, when the buy to sell ratio goes below 1, you want to get the heck out of the tunnel if you haven't gotten out of it already. But once the bird comes back to life, that's when the party starts. See what I mean? And so that's what led to the eventual blast off here. Now, what I want to do is walk you through a little bit of history in terms of VectorVest. And we're going to do that in a couple of ways. I'm first going to use some words, then we're going to go back into this market timing graph, and we're going to take a look at a few things. It used to be, many years ago, that we used to believe that the thing to do was to buy the best stocks that are out there once the market hit a bottom. We no longer believe that. You'll probably have a few of them in there. But what you want to do, and what I said earlier, was really focus more on the stocks that maybe have some value to them, but that have been beaten up the most. The ones that got clobbered, the ones that got smoked, the ones that went down 80%, in the correction. Those are the ones that tend to yield the most profit potential. And this is not the first time. You see let's look at the chart again and notice everything that we covered. This is not the first time this has happened, nor is it the last time that it's happened. So let me walk you through the market timing graph a little bit. So Jim, if you would, let's take us over to the program. And we're going to go to the market timing graph again. And if you would, let's put the buy to sell ratio on there for now. Excellent, sir. And if you would, make that an area. So he's going to right click, change type, area. Excellent. What we want to do here next, just to begin, is just go to our all weekly graph again. Realizing if we move to a daily chart, we can get even more precise. Okay? And what we're going to do is come back, and we're going to start with the easy one. This was the buying opportunity of a lifetime. We all agree? I mean, we've been in a 8-9 year bull market since. It really was. It was your best buying opportunity where he has his mouse in the last 74 years. May never see a buying opportunity again like that in your lifetime, by the way. But you might. And when you do, I want you to be ready. The good news is you're typically going to get a couple, 2 to maybe 3 bottom fishing opportunities in a typical calendar year. They're not going to be with the same gravitas as the one we had in March, but they're still going to yield tremendous potential over a few weeks, period of time, okay? But what I want to point out, if you look closely here, you'll again, on this March low, see the lower low price pattern. If you can just reiterate that with the mouse. And if you had a microscope, you'd notice that the buy to sell ratio was diverging upward. This was not the first time that we saw that. What I'm going to have Jim do is zoom in back here. That's good. And let's draw a line from this low, or even these two lows here. That's the same lower low pattern, is it not? Okay? And then if we look closely with the buy to sell ratio, you might have to take the line off because it'll be hard to draw it. Just unselect it. There you go. Because what I'm going to have you do is click on the first low with the date line. Oh, sorry, you don't have a date line. My bad, Jim. Excellent. So the buy to sell ratio over here on the right, you may not be able to see the number, so I'm going to tell you what it is. It's 0.07. Now we said that the area to start looking for bottom fishing opportunities is when the buy to sell ratio got below 0.2. We're below 0.2, yes? Have been for a little while. But there's been blood in the streets. It's gone down day after day after day after day after day. Are you thinking about buying stocks? Hopefully the answer now is no. Because what evidence do you have that stock prices have stopped going down and started going up? None. Okay? Now the market starts to rally here a little bit. And quite honestly, if you started taking nibbles at stocks in there, I don't have a problem with that. Because what did the stock market do only a month and a half later? A couple months later, maybe at the most. It really started to rally. When we say buying low and selling high, even if you bought stocks off this first little jump, are you buying low? Would you rather buy there or way back up here? There or here? It's like the eyeball test when you go to the eye doctor. Okay? The answer is simple. So even if you just follow the 0.2 rule, you're heading the right direction. You get the drift? But now we said we don't want to just get the drift. We want to get precise. Right? So the market makes a lower low as we indicated. Now, when we get to the second low, what's the buy to sell ratio number there? So now it's 0.17. 0.17 is greater than 0.04. Right? So the buy to sell ratio is making higher lows while the composite is making lower lows. With me? That's when you really start licking your chops. Even had you bought a few stocks before, that's fine. You still bought low. But now, if you still got gunpowder available, hopefully you got a lot of powder that's dry, okay? If you got gunpowder available, meaning you got money to put into the market, you're looking for the first evidence that you can find that the market has stopped going down and started going up again. So what I'm going to have Jim do here really quick is just zoom in a little tighter, would you? That's good. All right, so we don't have a traditional candlestick pattern here. Not quite. We don't even have a pierce. But the next day, as you've already witnessed the buy to sell ratio climbing up off of its lows and the composite falling, you're starting to get a sense this next day, if he goes forward one day, that's a pretty big day there. You see the size of the candle? So that means when we look at the candles, guys, there's these things called wicks. That represents the high price for the market that day and the low price. The body represents the open to the close. We haven't covered this, right? Okay. So on an unfilled candle, the open is at the low, the close is at the top. You with me so far? So not only did we have a big volatility day, who won the battle? The bulls, right? You can buy stocks the next day if she goes up. And what did she do? She went up. Okay? Also, the interesting little phenomenon that would occur here, you were all here sitting, I'm going to test you out. You were sitting here with Jim, right? The close on this candle is at the top of the body. If we count back 5 days, 1, 2, 3, 4, 5, is that close higher than the close 5 days ago? What is that called? Primary wave has changed direction. Isn't that cool? Yeah. What I've done is given you a way to look for, I got to start watching this because I'm about to get a primary wave up with the buy-to-sell ratio below 0.2 and climbing while the composite was falling. Hopefully you got all that. Because that's the closest thing you're going to find to being able to print money. You can be your own Fed. How cool is that? You can print lots of money that way. Right? All right? But it's observing these kinds of things in the past that led us to be able to produce an essay on March the 6th of 2009 that said itching to rally. Jim's going to tell you all about it. It's this kind of information that we've seen in the past with just this one indicator alone that allowed us to say, and we will exit our short positions and go long with one of the following strategies when the explosive rally occurs. We don't just wake up in the morning and say, you know what, hey Jim, I think the market's going to stop going down and start going up. That's not what we do. We look at this stuff right here. We look at our indicators and we use them religiously. And the really cool thing is, if you don't want to do this yourself, watch the daily color guard report. That was one of the important things. You know, and that slips through the cracks if we're not careful. Ray made a great point. Watch the daily color guard because we're going to tell you when we see this. If you want to know when the best buying opportunity is again, we're going to tell you. You just got to watch the report. Okay? The candle this one here? Yeah, you almost have a hanging man there, which is getting a little bit more advanced than I want to in this course. But it's almost a hanging man. But any candlestick pattern requires confirmation the next day, meaning a lower close, and you do not have it. So you would stay intact through that. Okay?
Just so you know you're on a weekly.
And this is a weekly chart. So it would be the next week. Thank you for that clarification. Okay? So the interesting thing about candlesticks and looking at hammers and haramis and all these things, incidentally, we have a candlestick course coming up, don't we, Ray?
We do.
It's next month, isn't it? It's on the 18th of this month. We're going to be teaching all about it. So if you want to get really good at knowing all these different types of patterns that we're going to talk about a little bit here, we'll teach it to you. Okay? Now, what I want to do is while we're here, let's go back into the slides. Let's go to the PowerPoint. And let's go, I got you from here. Next, we're going to talk about the market timing indicator. All right, the market timing indicator, as we mentioned, is all three indicators tracked as one, right? Composite, the buy to sell, and the RT tracked as one unit. When the MTI falls below 0.6, we say you're also searching for a bottom. Now, I will point out, these can be in isolation. They don't have to be together. And I'll show you evidence of that when we look at the Trump rally. Okay? It's important that one or the other exists. In other words, it's okay to be looking for a buying opportunity that you don't want to miss if just the MTI is below 0.6. But they typically work together. Or if just the buy-to-sell ratio is below 0.2. They can be used in isolation, but it's even more better. Sorry, loss of words. If that's English slang, by the way. But when they both happen together. Did you have a quick question?
On the slide that you had with the chart,
Yeah.
if you can go back to it for a second.
This one?
Yeah. What was the difference between the first, it looks like November 2008, where you had a low, no, up a little bit, that one?
Yep.
And then you did a lower low?
That would have been fine too.
Okay. But is there like an exit?
So his question was, why not these lows here as well?
That one, and then you created a second
Yeah.
lower low.
I would say this. It would have been even okay if you would have taken some nibbles at stocks through there. Now, we haven't gone the next level. And that is, we also provide the newsletter. And so you want to read the newsletter because there are some things that we look at in terms of the market climate that might lend itself to you knowing that the party is maybe not yet starting. See what I mean? So there's layers that we're working through. Okay? All right, now, the other thing that I would say there is the buy to sell ratio is continuing to head lower through that time frame. That's the short answer, but there's many answers maybe to that one question. Yep. Okay, now, the key point I was trying to make there is they can be used in isolation, but it's even better and more better if they're both happening together. But again, pay special attention to divergences between the VVC and the BSR. So let's go back to the chart. You can see a picture of it in your books, okay, in your slides. I meant to tell you to save that last one. You know what, Jim? Let's just go to, do we have another one open or no? I think we do. There you go, that one there. Click on that little guy right there. Excellent. So what I'm going to have Jim do is take off the buy to sell ratio and put on the MTI. All right, excellent. Now, here again, as price on the top graph, and he'll show you with his cursor, is making that lower low across that blue trend line, what is the MTI doing? Higher lows. You can draw that one if you want. The MTI is making higher lows. This again, not only have you achieved the level that you're looking for, and it's really okay to start nibbling at stocks with that in mind, the best opportunity is when you're hitting this higher low and you have a valid indication with price that it's getting ready to take off. Okay? So here you almost have a hammer. It looks like you could just grab that candlestick and hit Jim over the head with it. That's they call it a hammer. Okay? A little bit too much of an upper wick, so it's more of a dragonfly, honestly. But anyway, good. We said you need confirmation the next day. Do we get it? You do. So that's even more precise, actually. Okay? That's even more precise. And look what happened to, it's jumping again, right? It tried to jump before, and it's jumping again, but now you have the higher low behind it. So even more credence to what's happening off that bottom. All right, so these are some of the observations that we've made in the past. And this is actually back in 2002, before the 2003 bull market eventually took off. Okay? We've seen many evidences of this occurring. So let's go back to the all-weekly graph. And let's zoom into this one. And we've only got the MTI on here right now, but do we have a lower low on the composite? Yes. Yes, Steve. Excellent. Do we have a higher low with the MTI at the same time? Yes, Steve. All right, good. You got me that time. That's good. And what did the market do? Took off like a bird. Okay? Undo the zoom. Oh, sorry. You got to watch me. I'll put you in a pickle. Well, let's see. I know we got it here. Zoom in there. It's happened a lot more. It's just harder to see some of them. This one, you have to use the two most current lows here. You have a lower low situation on a short-term basis at the bottom there with a what on the MTI? So the downward underlying trend is dissipating, right? If the MTI measures underlying trend, what the picture is telling you is that the downward underlying trend is dissipating. It's slowing down. It's stalling. It's getting ready to do what? Turn around. And so all you got to be on the lookout for is for price to start turning around. So zoom in here. You have to undo the drawing. Keep going. That's good. So price is coming down, down, down. Oh, looky there. There's, what can you beat Jim over the head with? A hammer. You see the hammer? What happens the next day? Did we get confirmation of change? Yes. Now it happened there too, right? Had you bought stocks off either one of these? Because actually you could have. Are you buying low? Get the point? The most precise one typically comes though after the higher low on the indicators. So now you know to wait for it. And now you're mo better. Yeah, this, say again?
He's using the close of the day and the low of the day or the week for the...
That's correct, which is fine. It's good enough for government work.
Is that the right one?
Yeah, no, the correct way to draw the line would be across the lows.
I drew it when it was a 10-year graph. So
But that, we've kind of been scrunching and doing things with the graphs too. Jim knows that, believe me. Yeah. But now you know I've been around the block, right? All right. So let's go back into the PowerPoint here again, here real quick, Jim. So how many instances did I show you there in the time that I have allotted? 3. It's happened more than once. Guess what? If you look back, all you need to do when you go home, if you want to see more and more evidence, it doesn't happen every time. Those are the ones that are the easy ones to call. Okay, but as long as the MTI is below 0.6 and the buy to sell ratio is below 0.2, and you see something, the primary wave turning up, a candlestick formation with confirmation, the top 5 derby strategies turned from bearish to bullish. If you start to see these kinds of indications when our indicators are at those levels, if you buy and hold for several weeks, you're buying low. It's not going to go very much lower. Okay? But the trick is, the market has not stopped going down until what? It starts going up. Okay? And the best time to identify that is when these indicators hit those levels. So that was just another graphical representation of the whole enchilada. You have the MTI below 0.6, you have the higher lows while the composite's hitting lower lows. Okay? Oh, look at that. I didn't even know I had animations there. All right, so relative timing, essentially the same thing, guys. The same thing. And oftentimes you might even get a better or easier to pick out divergence with relative timing. It tends to move a little quicker at these lows than some of the other indicators do. So relative timing is one you shouldn't ignore either. There's no oversold level on RT. You're simply going to look for the higher lows when the other indicators are oversold. Okay? So there was the divergence. So seeing is believing. Take a look at an all-weekly market timing graph and you can spot them in an instant. I was able to zoom into 3, lickety-split. Let me show you something pretty cool because I want to kind of tell a story about it. Let's go back into the software. And this is what I want you to do, Jim. Let's start from scratch. Let's open up a brand new market timing graph just to make it easy. And the November rally is what I'm going to try to capture. I know you're going to do some work off the February rally, so I'm going to take a look at the November rally. So November of 2016, we got to just kind of scroll back a little bit. All right, so this was the election. The U.S. was heading into a very important time, right? And when you turned on the TV, how did it make you feel? Like the world was coming to an end. Almost. Am I alone? I'm not going to get into that. But, you know, so here again, Buffett's right? That's when you should be licking your chops. But the key is you need VectorVest by your side to help navigate it. Okay? That's the key. Without it, good luck. But here's what, just scroll back a little bit further. Just a little bit. Excellent. All right. So the market came off of a lower point here back a couple of times actually. Started really in February. You know, the first couple of months of 2016 were awful. Horrible time to be in the market. The market started to find its footing in mid-February. Made a couple of rallies with some mild retreats, and the market is turning over and looking a little sour heading into the election. And when you flipped on the tube, all you heard was all the reasons why the stock market's going to collapse, you know, yada, yada, yada. I don't want to try to recount everything, right? Well, I'm going to let you in on a little secret. Let's go to the bottom. So are you on November the 4th? Yes, we are.
Roger that.
That is the absolute bottom off of this little mini correction that we had there. What Jim's going to do on the right is just scroll down so I can show you some levels. Now I said earlier that they don't have to happen in unison. They can happen in isolation. Jim, I want you to go back one day. Jim goes back one day, and for anybody in the front row that might be able to read it, what does the level say? 0.2. 0.2. What are we thinking when we see that the buy to sell ratio has, well, you're thinking, oh my God, the election's coming. I don't want you to think like that anymore. You're licking your chops, guys. Okay? But you don't just go buying stocks that day because it hit 0.2. And that's the key. Because it could have gone to heck in a handbasket either way. You don't know. Right? But what's the likelihood? The market's oversold. Okay? Now the MTI made it into the 0.6s, but not below 0.60. And that's why I said they can be used in isolation. And I hate this expression, but again, good enough for government work. It's a market, and I'm not picking on any, you know, maybe I am. You got me. I'm going to get some markdowns on that one, I think. But, you know, that was the secret sauce. You know, everybody always wanted to know what the secret sauce in the Big Mac was, and now they know, right? Wasn't that difficult, actually. That's the secret sauce in identifying a market bottom. Look for those indicators. All the better if you have the higher low. You didn't even have the higher low situations here. But let me say this. Zoom into that bottom, that pivot. Okay? You actually have a candlestick formation here called a gravestone doji. Okay? It's called a gravestone doji, and you get confirmation the next day. Look how prices behave once the bottom actually sets in. That next day, off of this little gravestone doji, if Jim points right to, you know, it looks like there's a gravestone sticking out of the ground. Okay? Look at price the next day. What does that bar look like? Look at the range of that bar compared to all of the prior bars you can see on the down wave. And it gapped too. We can go into gap theory a little later. That's a breakaway gap, actually. Gotcha. Right? But that's the key. And also look at the close. Did it close strong or weak? So you got to be thinking, hey man, I've got confirmation here, and hopefully you got in fairly early that day. Okay? And you would be handsomely rewarded. And we're going to show you evidence of that when we start. I can't buy stocks right now because we're talking about what? When to buy. Okay, and I'm going to stay focused, laser focused on when. Now, if you wanted to wait to get through the election, I really don't have a problem with that. Maybe the smart thing to have done, though, was to start to nibble. And then when you're right, what do? You cost average up. You never, ever, never, never, ever, never, never, ever cost average down. If you want to cost average, you start cost averaging when prices are low, and when you know you're right. When do we start knowing we're right in VectorVest? How about a green light in the price column of the color guard? So you took a nibble on the bottom, now you got a green light, what do? Buy more. Now you got it confirmed up, what do? Buy more. See what I mean? There's no divergence here, and they don't have to be there. The divergences are special situations where you absolutely know it's in spades at that point. Okay? Spades being a high suit in cards. In other words, you know it's happening. Okay? The other way you know it's happening is when you see these candlesticks and these explosive days, and the primary wave is going to change to up. That was the key. All right, and so that would have been a great time, because if Jim takes the right-hand edge here and just kind of slowly, just drag that out to the right, would you? Just keep kind of slowly dragging it out. So I ask you the question, was it better to buy stocks right now where he is, or back where we started? But we're living here now. So what are you going to do when this happens again? You're going to buy stocks. And now you know when the best time to buy stocks is. And it's not that you can't buy stocks tomorrow. You know? The market's still rallying, isn't it? It's not that you can't buy stocks now, but when was the best time to buy stocks? We started off this whole conference with, you came here to learn how to buy low and sell high. The easiest way to do that is to buy at market bottoms. And in VectorVest, go back and look. If you don't believe me, go back and look. And you tell me whether you were buying low or buying high when those indicators are at those levels. Jim, give me the all-weekly graph. I'm not letting them out of here until I see everybody zoned in saying, now I know. Yeah. Now I know. Jim, just start clicking on times when the buy to sell ratio is below 0.2. That's as close as you can get. You take the other indicators off if it helps. Just go to the low points, right? There's one right there. Was that buying low if you bought early? Okay. Now look, if we go back, even start over here on the far left-hand edge, go to the very first one. Could we have bought low there? All right, zoom in a little bit so they believe me. Could we have bought low there? What about, did we get to 0.2 here? Not quite. Did we get, not quite. Oh, look at that. See how sexy that is? You're not at the bottom yet. Keep going. Let's see where we are now. 0.21, what, go forward. Didn't quite make it that time. Where is it now? 0.04. Would you rather have bought on, would you rather have bought on, and show with your mouse, would you rather have bought on that low, or that low? Now you did it. Thanks for coming.